All right, let's dive into the exciting world of mutual funds. Have you ever wondered what mutual funds are and how they can benefit you? Well, you're in the right place because today we're going to explore everything you need to know about investing in mutual funds. Future investors, are you ready to dive into the world of mutual funds and start building your wealth in 2024? Investing in mutual funds is a fantastic way to diversify your portfolio and benefit from professional management. In this guide, we'll break down everything you need to know about mutual funds, from understanding what they are to choosing the right ones for your financial goals. Let's get started. What are mutual funds? Definition: a mutual fund is a type of investment vehicle that pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. How they work: pooling money. Investors buy shares of the mutual fund, contributing to a common pool of money. Professional management. A professional fund manager uses this pool of money to invest in a variety of securities. Diversification. By investing in a mutual fund, you gain exposure to a diversified portfolio, which helps spread risk. Benefits of investing in mutual funds. 1. Diversification. Mutual funds invest in a wide range of assets, reducing the risk of loss if one particular investment performs poorly. 2. Professional management. Experienced fund managers make investment decisions on your behalf, leveraging their expertise to maximize returns. 3. Liquidity. Mutual fund shares can be easily bought or sold at their net asset value at the end of each trading day, providing flexibility. 4. Accessibility. With relatively low minimum investment requirements, mutual funds are accessible to a wide range of investors. 5. Convenience. Mutual funds simplify the investment process by handling the research, buying, and selling of individual securities. Types of mutual funds. 1. Equity funds. These funds invest primarily in stocks. They offer the potential for high returns but come with higher risk. 2. Bond funds. These funds invest in bonds and other debt instruments. They provide regular income with lower risk compared to equity funds. 3. Balanced funds. Balanced funds invest in a mix of stocks and bonds to balance risk and return. 4. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500. They offer broad market exposure with lower fees. 5. Money market funds. These funds invest in short-term, high-quality debt securities and provide a safe place to park cash with minimal risk. How to choose the right mutual fund. Step 1. Define your financial goals. Short-term goals: saving for a vacation, emergency fund, etc. Long-term goals: retirement and buying a home, education fund. Step 2. Assess your risk tolerance. Conservative: prefer stability and lower risk. Moderate: willing to take on some risk for potential higher returns. Aggressive: comfortable with high risk for the possibility of substantial returns. Step 3. Research funds' performance history. Look at the fund's past performance over different time periods. Fund manager. Consider the experience and track record of the fund manager. Fees and expenses. Compare expense ratios and other fees that can impact your returns. Investment strategy. Understand the fund's investment strategy and whether it aligns with your goals. Step 4. Diversify your portfolio. Spread your investments across different types of mutual funds to manage risk and optimize returns. How to invest in mutual funds. Step 1. Open an investment account. You can invest in mutual funds through brokerage accounts, mutual fund companies, or retirement accounts like IRAs. Step 2. Choose the funds. Based on your research, select the mutual funds that align with your financial goals and risk tolerance. Step 3. Decide on the investment amount. Determine how much you want to invest initially and set up automatic contributions if possible. Step 4. Make the purchase. Buy shares of the mutual funds through your investment account. Step 5. Monitor and review. Regularly review your investments to ensure they continue to meet your financial goals and make adjustments as needed. Tips for successful mutual fund investing. Tip 1. Start early. The earlier you start investing, the more time your money has to grow through the power of compounding. Tip 2. Invest regularly. Consider setting up automatic contributions to your mutual fund investments to take advantage of dollar-cost averaging. Tip 3. Reinvest dividends. Reinvest any dividends earned to buy more shares and accelerate growth. Tip 4. Stay informed. Keep up with market trends, economic news, and fund performance to make informed decisions. Tip 5. Be patient. Investing in mutual funds is a long-term strategy. Stay patient and avoid reacting to short-term market fluctuations. Common mistakes to avoid. 1. Chasing past performance. Just because a fund performed well in the past doesn't guarantee future success. Focus on long-term performance and consistency. 2. Ignoring fees. High fees can significantly erode your returns over time. Be mindful of expense ratios and other costs. 3. Lack of diversification. Avoid putting all your money into one fund or asset class. Diversify to spread risk. 4. Timing the market. Attempting to time the market can lead to poor investment decisions. Stick to a long-term strategy and stay the course. 5. Overlooking risk tolerance. Invest according to your risk tolerance. Don't invest in high-risk funds if you're not comfortable with potential losses. If you found this guide helpful, don't forget to like, share, and subscribe for more tips on investing and personal finance. Happy investing! Mutual funds are a fantastic option for beginners looking to dip their toes into the world of investing. They pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Mutual funds are a popular investment option for beginners looking to grow their wealth over time. These funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. This diversification helps reduce risk and can provide more stable returns compared to investing in individual stocks or bonds. Another benefit of mutual funds is diversification. By investing in a mutual fund, you are spreading your investment across a wide range of securities. Mutual funds also offer liquidity, meaning you can easily buy and sell shares of the fund. This makes mutual funds a flexible investment option that can be easily adjusted to meet your changing financial goals. It's also important to consider the fund's performance history when choosing a mutual fund to invest in. Past performance is not indicative of future results, but looking at how a fund has performed in the past can give you an idea of how the fund may perform in the future. Be sure to research the fund's performance and compare it to similar funds to ensure you are making an informed investment decision. When investing in mutual funds, it's important to have a long-term perspective. Mutual funds are designed for long-term investing, so it's important to be patient and allow your investment to grow over time. Avoid emotional decisions based on short-term market fluctuations and think long-term. Overall, mutual funds can be a great investment option for beginners looking to grow their wealth over time. With professional management, diversification, liquidity, and the potential for solid returns, mutual funds offer a convenient and effective way to invest in the stock market. By carefully researching and selecting the right mutual fund for your investment goals, you can set yourself up for long-term financial success. Don't forget to subscribe for more investment tips and share your experiences with mutual funds in the comments below. Happy investing!